Arca's director of research lays out the case of buying Ethereum ahead of the merge. Katie Talati, the director of research at investment firm Arca, thinks traditional finance institutions are at risk of missing out on a once-in-a-decade trade. Right now, she said, Ether is woefully underpriced and there's a catalyst around the corner. Next month, Ethereum will have billions of dollars worth of cryptocurrencies, millions of users, and thousands of apps transferring to a new and improved blockchain. This follows years of research and development that will culminate in the so-called merge, the actual technical deployment of Ethereum's proof-of-stake chain. This is an event that a lot of people are undercounting, especially based on current price appreciation of Ether, said Talati, who also leads Arca's investment research. We're going to look back on this in a year from now and realize we were at the market bottom there. Of course, this is just Talati's opinion, but it's an opinion widely shared widely among industry insiders. The merge has market upside potential at a time when most headlines spell risk and not reward for cryptocurrency holders. From Arca's perch, Talati has observed an increased retail interest in crypto in the past few weeks. Yet there aren't new institutions coming in, she said. Those will be the much more important and larger buyers of Ether. There are structural reasons why one might expect ETH's price to appreciate post-merge, Talati said. From a financial standpoint, the net issuance of Ether supply is going to be net negative, she said. Yes, but it's not implemented yet. So the actual effect of that taking place doesn't start impacting the network until a few months after the merge, right? And it's not going to skyrocket in anticipation for that. It's like you have to pull the supply out before you can realize the price of the supply being pulled out. What's a good, GPUs are a good example, right? We have a flood of GPUs into the market right now. And even though there are shortages possibly on the horizon, you aren't going to see the price of GPUs go up in speculation of some shortage that may happen next year due to, greater macroeconomic supply chain issues between Taiwan and China and all of that. Yes, that is something we're aware of that's going to happen, but that doesn't affect the fact that there are too many GPUs on the market right now, right? So if there's a bunch of Ethereum on the market right now, it's not like the price of that Ethereum is going to go up, because guess what? There's more Ethereum on the network right now available for people to buy up. So the price doesn't change until the actual effect of the deflationary currency post proof of stake takes place. You can't expect it to just go up because people are expecting it to be deflationary later on. You still have that same amount of supply. Supply has to start being taken out of Ethereum before the price reacts to that. So that doesn't actually affect what the value of the merge or of Ethereum due to the merge is. This is the result of an Ethereum improvement proposal, specifically EIP 1559, instituted last year, that burns ETH as part of every successful transaction, and a change in Ethereum's issuance post-merge. For at least 6 months after Ethereum ditches proof of work, users who stake their assets will not be immediately able to withdraw their assets. Yes! I am so glad some people are getting this right. Thank you, CoinDesk. Thank you. All right. This creates a supply sink that essentially caps the issuance of new Ethereum entering into circulation, she said. This is the other thing about this, because you need to take this into account. Once again, it doesn't mean that the Ethereum isn't there. It just means that they're manipulating it. So it'll be deflationary because nobody is able to withdraw it, right? So you earn that stake, it gets put in, you can't pull that stake out. So the time that this gets priced in, right, is And this is a weird one too, because it's kind of fake, if I understand it correctly. Let me know if I get this right. So because you can't withdraw, okay, but fees are still being burned, it means that there's less Ethereum in the actual tradable ecosystem. So there's less Ethereum actually within liquidity. But that doesn't mean that Ethereum doesn't exist, because that Ethereum does exist on the Ethereum nodes. They just can't withdraw it yet, right? So track with me. So what does that end up meaning? In the short term, it appears deflationary, but in the long term, it's not actually deflationary. So once they unlock staking withdrawals, then you get back into the same point that you were in before, making the entire point moot when you say that it's deflationary for that period of time. You are deflationary for the period of time where you were not allowed to unstake or withdraw your staked Ethereum, right? Once you are able to withdraw that, then at that point, it once again becomes inflationary or more inflationary than it was. And in fact, to a much larger degree, because now you have a falsely inflated price with poor staking rewards that translates into a dumping of Ethereum into the market and a huge influx of liquidity to all exchanges. Meaning, you will have a short-term increase in the price of Ethereum, but in the long term, you have a much larger potential for the price of Ethereum to come down as an influx of all the unstaked Ether and comes in. Add the fact that there will now be an incentive for people to lock up their ETH on Ethereum to earn a staking reward. You will see a circulating supply of Ether increase with staking, but it won't actually be available for individuals to sell, Talati said. So that's correct. I just think that she's coming to the improper conclusion. Some people have referred to this as Ethereum's thirdening, a reference to Bitcoin's halvening or the cyclical decrease in new Bitcoin issuance every 4 years. These programmatic cuts to supply are sometimes thought to drive up prices, or at least drive awareness to cryptocurrency markets. Still, there are risks to the trade. First, Ethereum's merge could be delayed, which would send a negative signal to the markets, at least in the short term, Talati said. Then there's the prospect that something could go wildly wrong during or after the deployment, which is what I talked about before, right? If you're going to hold it through the merge, you have one of two options. One of two things is going to happen. It's going to be successful, and it's probably going to short-term skyrocket. Or it's going to be unsuccessful and it's going to short-term dump. So unless you want to play a 50-50 chance flip, you probably don't want to be in the Ethereum through the merge, right? At least that's how I would feel about it, because I don't like those odds, right? The odds of flipping a coin don't seem that great to me. And there's probably, the actual probability is probably off. We could say that it could be up to 60% successful. Maybe based on the previous testnet participation, but then there's more factors that go into it as well, right? Another risk are all the planned and possible Ethereum forks that will keep the proof of work algorithm. This will fracture the market, Talati said. Some prominent crypto firms have already pledged to support some proof of work chains like ETH proof of work, with which prominent miner and investor Chandler Go has backed. There's also the possible sell pressure of ETH. Once people will be able to unlock their coins, some people have locked their ETH for nearly 2 years, ever since the so-called Ethereum 2.0 deposit contract went live with the experimental Beacon chain. They've also earned returns on their capital in the form of staking rewards that could be sold for cash or reinvested. It's kind of hard to predict that behavior, Talati said, adding that many early stakers are likely long-term supporters of Ethereum who would be less inclined to sell. Well, as we know, in 2020, we had 80% of that staked ETH was the Ethereum Foundation. So to be fair, that 80%, and now that number has changed a lot, of course, too, but that large investment from Ethereum Foundation, I don't think you have to worry about getting removed from the market, right? Because it's basically controlled by the people that control Ethereum. I mean, they're not going to just tank the price of their coin by selling all of that off, unless it does end up being the world's greatest rug pull that we've ever seen in cryptocurrency. I suppose that could be something that happens, but I highly doubt it. It's worth adding that much of Ethereum's issuance schedule could change. There is no guarantee that ETH will become deflationary, a major selling point for institutions, which depends on high levels of Ethereum use, and thus high levels of burnt ETH. So considering the financial, technical, and other unpredictable risks of the largest blockchain upgrade in history, is there a way to hedge your bets? Investors seem to be aware of the downside risk. Put options or contracts that allow people to option to sell an asset for ETH are really expensive in the current market, Talati said. So they didn't really answer the question. Is the price of the merge, and this is extremely frustrating, is the price of Ethereum priced in already or not? My argument would be it was, and it's not right now, due to, I think, greater economic kind of implications that are going on. I do think you would see around, a peak to 2,000. Once again, not financial advice, before the merge. And then it will either go up from there based on it being successful, or down from there based on it being unsuccessful post-merge. And that's pretty much where I think you're at. But priced in merge, kind of pre-merge value, probably right around that $2,000 mark. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here, or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com, where you can become a member for free, or choose to be a $5 a month supporter that unlocks additional content.